All right, well, good morning, everyone. Paul Duncan here with my son, Greg, and I see a number of folks starting to roll in. So while they're getting connected, we'll kick this off and go through some of the admin stuff. Thanks for making the time today to come and listen to us and hopefully engage us and ask questions, and maybe we can clarify some things that may not be clear for you. I'm presuming everybody can see the screen here. And so if you need to reach out to me directly, the easiest way to reach out is through the phone number there, through the email that you see there. Many of you are aware that I do have a Twitter feed that a lot of these alerts are sent to, and that's at Greek God Trading. As you see right there, you can follow that Twitter feed, and you'll get some of the alerts, the breakout alerts, the Darvis breakout alerts. All of our TradeStation trades that Greg and I do are echoed to the public, so you'll see every trade we take, and you'll see every, the good, the bad, the ugly, right? So you'll see it when we actually close our trades and what we're doing. Not that you're to follow us. I want to urge you not to follow us at all, but I do want you to see that we're trying to be as transparent as possible as we go forward here. So a couple things. I do have a Dropbox, and in the Dropbox, there are a number of files and things that you'll see as we go forward. If you're interested in getting a subscription, which then if you have Dropbox on your desktop or your device, you'll get a pop-up anytime we populate things in those folders. And so send an email to that GreekGodTrading@gmail.com with the subject of Dropbox, and it makes it easy for me to filter out and add you. We also have a newsletter. I haven't been publishing the newsletter, but Greg and I are getting ready to kick that back off. And if you're interested in getting a monthly newsletter, just go ahead and let me know. We don't sell any lists. We're not selling anything in the newsletter or anything like that. It's just basically doing some deep dives on some concepts that, eventually I think could be, when stacked together, could be a blog or something like that. And then finally, as many of you are aware, I am the Washington, D.C. administrator for the Computer Investing Special Interest Group. We do have a website on groups.io, and if you're not a member of that, please send a email to the CISIG or CISIG plus subscribe at groups.io, and we'll get you added to that. And that's how we communicate and answer questions and basically keep things within the group, but there's no obligation to be a member of AAII, for instance. There's no obligation to join anything other than the group, just so I don't have to make special arrangements to communicate outside of the group, which gets burdensome if we're not part of the group. Just the cover my tail disclaimer, the bottom line is in bold down there. I'm not liable for any errors and inaccuracies. So sometimes this is done late at night, early in the morning, and sometimes, as Greg caught me, I was making a statement on what I thought was a daily chart, but it was a weekly chart. And so sometimes the information may be incorrect. So don't act on anything you see here without doing your own due diligence, please. This is all for educational purposes, and I just want to make sure that everybody's on board with that. And especially as a representative of AAII, I try to be as accurate as possible. But again, you're on your own for actual pulling the trigger, paper trading, or actual live trading here. Some disclosures. Greg and I own some of the equities that you're going to see here. In fact, just assume that we own them if we talk about them, because we've studied them. Our primary brokerage platform is TradeStation. I also have E-Trade and Fidelity on some other accounts. Greg uses TradingView for most of his analysis, and we'll be shelling out, passing the baton back and forth between Greg and myself today, and you'll see me predominantly in TradeStation and him predominantly in TradingView. Another disclosure, I have a subscription to something called Trading Line. Or Trader Line, it should be. The link is there, and also TradingView, which we both like. You will not see any material from Trader Line, but my world obviously is influenced by what we see there. And we can talk later if there's interest about what that really means. So today, what I want to touch on, or what Greg and I want to touch on, what's our overall philosophy? I know there's some new names here that we've got here on the screen. So just what's our approach to trading and investing here? And there's a lot of different flavors out there. I just want to make sure that if you're watching this, that we're in alignment with your expectations. I'll give you what we see as the view of the markets, specifically looking at the SPX and the Qs. We'll move into picking good stocks. And, Sanjay, I see that you're on. Thanks for making the time this morning. Sanjay just gave a talk on this a few nights ago for the IBD group here in Northern Virginia, where he actually talked about a lot of what we're going to cover here today also. So there's good duplication, but also good complementary thoughts here. So it all starts, as many of you know, if you pick bad stocks, it doesn't matter how you manage it. A bad stock is a bad stock. But if you pick a good stock and you manage it well, you're going to do very well, right? So that's really what our focus is here. How do we pick good stocks? Risk management. We're going to talk a little bit more about that. I know there was, we put a poll together in the group, and this was one of the items that everyone expressed interest in. So we're going to talk a little bit more about risk management and how we approach risk management. Mind you, this is all a very high level. We're not necessarily getting into the depths and the Excel spreadsheets, but we certainly could dive as deep as you wanted to go. Another topic that was of interest, but we just, frankly, we're going to run out of time. So we'll move this to next month, is really money management. And that goes towards the number of positions, how you scale in, how you scale out. We'll touch a little bit on scaling today. You'll see some definite examples of how we scale. There's some math behind how you would want to scale and what you want to do there. And then, when do you take partial profits, and what does that mean? And so we'll push that over into next month's presentation. One thing that you guys wanted to hear us talk about was the importance of the trend and how to measure, how to act. And so there's a number of considerations to look at that, and we'll show you how we build our confidence in the trend, not just taking something like IBD, which says, we're in an uptrend. Well, what's that mean? What does that really, what's the focus there? And then very high on the list was actually this free and paid tools that can help reduce the noise. And so what we did, rather than just go through a listing of the free and paid tools, we've integrated it throughout. And we're going to focus today on really two things. FinViz, which most of you are probably aware of, but we're going to go back and forth with FinViz and Marketsmith, IBD. And the reason for that is those really help you discern. One gets you in the right playing field. The other one will get you on base and really start helping you execute. And then at the end, provided there's interest or time, we could do questions and answers, do chart reviews. We'll call up whatever charts and start talking about them, things related to that. So if there are no questions or anything from that, I'd be happy to kick things forward. I see there was a couple chats. Is there anything there that we need to kick over, Greg?
No, it's good to go.
Okay, great. All right. So what are the influencers? So just to tell a quick story here, COVID actually has some benefits. Greg came back from college in March, and we started really in earnest looking at investing. And I started him off with Mark Minervini's books up here. And he has progressed through the library here in one form or another. I know, Greg, go ahead, talk about what you've seen with O'Neill and Boykin and others. But for us, these are really the seminal guides for if you're looking to really turn your trading and investing around. These should be part of your library. I'll be quiet, and Greg, if you have any 2 cents to add, please do.
Yeah, I mean, I would just say Livermore is, like we have on the slide, the greatest of all time. But in his books, or especially in reminiscences of a stock operator, it wasn't necessarily like criteria that you get in Minervini's books or even in O'Neill's books. You just see the psychology behind one of the best traders of all time. So that book's just invaluable in itself. And then I moved from, like Dad said, from Minervini into O'Neill. I think O'Neill is, you know, the second greatest of all time, or he can be in the conversation for greatest of all time. But he's the one that has given all of us, basically all of the growth stock investors, at least that use IBD, a you know, sure way and a sure criteria selection to look for stocks. And so Minervini, you know, piggybacks off that and has his own little, you know, additions to his trend template and stuff like that. But yeah, I would advise everyone to really pay attention to Livermore, O'Neill, all the names we've said here. But you know, they're basically how I got started, and I've read most of those books many times already now. So you know, you learn something new every time. But
one book that folks may not be aware of, is this one down here called The Life Cycle Trade. It came out a couple years ago. Kathy Donnelly is one of the authors here. She's associated with IBD, and if you haven't picked this book up, it's actually a very thin read. It's not a very heavy-duty book at all. Why it's relevant, if you want to understand, they've gone through some pretty good details on how to characterize IPOs and the stages of IPOs. I find it amazingly, it like cut through the clouds of you know, just, oh, it's an IPO. It's before the 180-day lockout. It's after the 180-day lockout. Now there's a classification system that they brought together with statistics on what patterns work, what don't work, and things related to that. If you're not familiar with this book, I do urge you to take a look at it. It's a pretty good book. Okay, enough of that. So what's our base? So I know a number of folks here are new. What's our basic philosophy here? The first one is that you have to invest within your ability to manage risk. It doesn't matter what kind of trader or investor you are. If you don't manage risk, you're going to abandon whatever it is that you were doing in the first place, right? You're gonna be like a rudderless boat out there. So you can see that's number one. You've got to figure out your risk. You got to figure out what you're going to do from that point. And then the other, it's not a misprint. The other ones are all number twos. They're all equally important. I just can't, they're just laid out top to bottom here. It's mostly about not losing money, right? Not making mistakes. If you can consistently manage your risk and not make mistakes, you're probably going to be okay, especially with what we talk about in overall trend following and things related to that. And you're going to see this over and over today. Buying right is the fundamental aspect here, right? If you can buy right, and what that means, entering the stock at the proper time. We're going to talk in some details about that today. And then finally, there are a number of folks who will always say that value investing and buying a stock that has been beat up presents a great opportunity. And I'm not here to dispel that or argue against that at all. But I do want to say it's proven that stocks that are firing on all cylinders continue to fire on all cylinders until they don't. And just because a stock is hitting a new high doesn't mean it's going to stop hitting a new high. It means there's no overhead resistance, and it could keep going depending on what the available market is. This has been proven by, as we just said, O'Neill and Minervini and others, and it is really the focus of monster stocks and how you get on board. So I just want to say I'm not against value investing or other types of day trading, et cetera. They all have their place. It's just not what we're focused on here and not what we're going to talk about. So let's get into the meat. I know that was 6 slides of overview, but it's important to get that stuff out of the way. But now let's really take a snapshot of where we are. So what's the overall market status according to IBD or according to Marketsmith? So the markets, as of yesterday, the S&P finished at another all-time high, and we'll see that here shortly. They're saying the market's in a confirmed uptrend, and we're not in any quote unquote danger of distribution. We've got 1 day on the NASDAQ, which means you've got higher volume on a pullback, and the same thing on the SPY. So while that's true and it's a snapshot in time, I think the challenge is that it only tells part of the story. So this is a weekly chart right now that you're looking at of the SPX, of the S&P 500. And you can see that in the upper right-hand corner, we continue to go higher. And I've got 2 moving averages that are on here. The purple one that you see on here is a 4-week moving average or a 20-day moving average. And then the yellow one that you see here is a 10-week moving average or a 50-day moving average. And what you basically see is that we've had a couple retests where the SPY has come down and it's held the 50, which is always a very good thing to see. It's still confirmation of the trend, even though it broke through the 21 or broke through the 20 in these cases. You can see we're just marching upward. And folks will say, well, now that we're across the top here, that it's time to pull back. The fact that we closed above, this is called the Darvas box, the fact that we closed above this threshold, we're in new territory. And what that means is that overhead supply to sell is very limited, and provided that the market environment stays consistent with where we are, we could just see this thing grind higher. As I say here in the bottom, we could absolutely grind higher until it doesn't. And there's a number of things in the market that we don't have to get into necessarily today that are supporting us to continue to go higher. But there's a couple of things I also want you to be aware of. When we go to the daily view, and this is basically now going from the weekly view of the previous to the daily view, there's a few things that I want to highlight here. So this is a trend line, or what's called a regression line. And the regression line basically forms the best fit straight line of all of the daily closes that we're seeing on the S&P. And what you can see is that we're above that line. Now, that doesn't mean to do anything, it doesn't mean to sell anything. It doesn't mean to do anything, to take a defensive posture, but it's a warning sign, right? You can see that when we've approached this upper error bound, or in this particular case, it's a standard deviation, you can see that we always do come back. Now, where do we come back to? We come back to the 21-day. This is the purple that you see here is called an exponential moving average. And you can see that we come back. Sometimes we violate, but we come right back the next day. And typically, this isn't a volume chart down here. I'll explain this in a second. But typically, it's on volume, and it's just showing that people are stepping in. The big institutions are stepping in, and they're moving the index back up. And so now we get this ebb and flow back and forth. And you can see it's not unreasonable at this point to expect that the markets are a little overheated. So even though we're in an uptrend, according to Marketsmith, we're in an uptrend, but we're overheated. And you can see now on the bottom, there's something here that's called Webby's RSI. This is Mike Webster. He was formerly with IBD up until a week ago. He's created something called the really simple indicator. This isn't the traditional, relative strength indicator that we're used to seeing. Basically, it just takes the low of whatever it's being applied to, in this case, an index, and it looks at it compared to the 21-day moving average. And this is something that he's used for some time. And basically what he's saying here is that it's becoming extended. And an ideal growth range is between 0.5% to 2%. And you can see on the SPY, we're actually up to 2.84. So again, we're starting to see a walk up, and you can still have it sustained, but we're starting to see a walk up where we've got over range here, and we're starting to see some over range here. So just a couple of caution flags here. And as Mike Webster would say, this is you're taking your foot off the gas, but keep it off the brake. You don't need to do anything, but necessarily maybe don't institute new positions at this time. Just take a look at whatever is going on. Now, there's something else that I've got on here called the power trend. IBD has a thing called the power trend, and we're still bullish. So this is still one of the trending indicators, and I'll talk about it later in the presentation today. But the bottom line here is that we're still a go on the power trend, so we're in a good confirmed uptrend. You can tell by the slope of the regression line, for instance, just a little overheated. Now let's take the same approach and look at the Qs, because I think this is relatively important. The Qs have actually outperformed the S&P 500 by a considerable amount. So when we go back to the weekly, you can see we left the upper right-hand part of the box. You know, we've just continued to march upward. Again, we got the 4-week on the red line, and we've got the 10-week on the yellow line. And you can see we've never even hit the 10-week on the Qs, right, on the NASDAQ. So we're just cranking forward here. And volume, you can see we had good volume this past week, right? So we had a significant up week on volume. That's interesting, because that means we've got institutional participation and all the things that you want to see in an uptrending market. But when we take a look at that same presentation that we applied to the SPY, you can see we're overheated again, Wednesday, Thursday, Friday, still overheated. You can see that we're now over the 4 level. Instead of the 2.84 that we were seeing before with the SPY, we're at 4.48. That's why I colored this thing red. We are overheated on the Qs. So the technology laden NASDAQ is definitely given us a signal that perhaps we should be taking a close look at our portfolios, and perhaps it's time to start looking at maybe taking a little off the table, just anticipating a pullback. Again, not saying to do this, but be aware that it could come at any time, because historically you can see when we've looked at this, we typically do pull back a little bit, and you know, you're giving up some of your gains. So just be aware this is out there. And so what is the view that you know I'm seeing in the overall markets, or that we're seeing, that Greg and I are seeing? The uptrend is continuing. There's no question of that. And this is evidenced by this power trend that you see here, you know, the regression line, power trend and the regression lines, etc. Everything's looking really good. The S&P is slightly overextended. The NASDAQ is overextended. So I'm going to give it a, you know, the yellow caution light here. We're hitting the all-time highs. We've got minimal overhead resistance. This could grind higher. Absolutely do not get lulled into, oh, I got to take everything off the table. That is not what we're saying here at all. We're saying perhaps you should be a little more vigilant. Caution is advised if you're holding technology stocks, right? Because the NASDAQ is a little more, or is overheated compared to the SPY. And then if your stocks are correlated with the SPY or with the Qs, you are, you know, definitely exposed to a possible shakeout. I'm going to show you how you can get a kind of a qualitative view of that. So remember 2 things. The market climbs a wall of worry. I think we all know that, but I want you to internalize that, right? All these things that say, oh, we can't go any higher, you know, this, that, and the other thing, that's when the market actually does do well, right? Volatility goes up, et cetera, et cetera. And like you've always heard me say, your crystal ball is as good as mine. So let's, just as an aside here, when I put this on here about, you know, if you're correlated, it occurred to me, perhaps some of you don't know how to determine if you're correlated. And so I wanted to give you a tool. It's free. That's out there. This link, if you download the PDF, I posted a message in the groups.io forum about a link to the PowerPoint, or excuse me, the PDF of this. It should be a hot link, so you should be able to click on it. When you click on that, you're given this type of setup, and I typed in, just for Greg and I just wanted to see, these are our holdings right now. These are the stocks that were in our combined portfolios across 5 different accounts. And I wanted to see how correlated we were, right? So this is the setup. So you can go do this with your own holdings. You can type this in there. I chose the 3/23 date because that's really the bottom of this V-shaped recovery, and it just gives us a good runway to come up. How? Because behaviors changed after we hit that bottom, right? So this is a opportunity to see, since that bottom, you know, how have we performed? Doing daily returns, and then I'm not showing you the rolling correlation today. But when you do this, you get a table. And I included, I don't know if you saw this, but I snuck in the SPY and the Qs, right? Because I want to refer to those as my reference points. So that's what we've been talking about. So these are the markets, and then everything else is what Greg and I are holding. So when you do this, you get a table, and you get the SPY and the Qs, and then you get all the stocks, and then you get them here. And what it does is it plots the correlation that you see here. And I just wanted to highlight the market here in green, and then I've thrown some arrows in here to show it. Now, in correlation terms, when you get a 1, you're positively correlated. So 1 looks like the other exactly. And you could see that the Q and the SPY are correlated to 0.9. Now, you remember those graphs that we had showing that the Qs had really taken off, but the SPY hadn't taken off as much. And that's why you get a slight difference between the two. They're not the same. The indexes are not the same. They're not behaving exactly the same. And the correlation is 0.9. They're very correlated, but they're not exact. And then you can take a look at the different stocks here. And if you have a 0 correlation, they're literally what's called orthogonal. They're not correlated. They don't have anything to do with each other. And then if it's -1, that means it's oppositely correlated. So basically, if something goes up, the other one goes down the exact amount by if it's -1. But you can see here that Zoom, for instance, is relatively uncorrelated with the SPY and not really correlated at all with the Qs, because Zoom has kind of been marching to their own drummer. Right? So that's a positive. So that would tell me, in terms of management, I might not be as quick to sell Zoom if we get a correction. I would want to look at Zoom individually and not necessarily think of it as being, oh, I got to get out of the stock. Same thing with Peloton. You can see with the SPY a 0.01 correlation. It hasn't been correlated. All these correlations could change, but it hasn't been closely correlated over the last 60 days. And the same with the Qs, right? Somewhat correlated, but not heavily correlated. But you can see that there's a lot of red arrows that I threw in here. And that's because we're starting to get closer and closer to that 1.0. So here we've got Zillow, which is at a 0.6 with the SPY, 0.56 with the Qs, Square 0.66, right? It's getting closer to being correlated. So you see how this works, right? And these are all stocks that have had, over here on the right-hand side, have had a phenomenal takeoff of the bottom of that V-shaped recovery. So what's your takeaway from this? If you're dealing with stocks that have a pretty high level of correlation, you may want to take a closer look at, if the markets do come back, because we know we're a little overheated, maybe I'd want to take a little bit of the profits that I have in these stocks off the table.
In the middle tier, I'm going to put a couple of the radios, but it'll get them all up. I can have my key and everything underneath. So.
Oops. What was that? Or did you go back on mute? Okay. Yeah, thanks for everyone for self-muting if you can. I appreciate it. So the takeaway is this, guys. I think we're in good shape. There is the ability to run a correlation. You might want to do this just to see where you form. And this, what you see here, is basically how I'm going to look at some of my stocks, and if I want to lighten up on them in the event of any type of weakness that I see in broader markets, I might lighten up on the ones that are showing red. Okay. So that is what it is. Let's start talking about picking quality stocks. And as many of you are aware, Greg and I both feel that this is really where it starts. If you pick poor stocks, it's really hard to manage them into a profitable situation. If you pick great stocks, certainly you can mismanage, but as I said earlier, as long as you don't make any major mistakes, you're probably going to do pretty well. So how do we do that? As most of you are aware, we're both Minervini and William O'Neill aficionados. I'm going to start with the Minervini trend template. If you don't have this book, I urge you to get it. But in chapter 5, he's got on page 79, he basically has the trend template laid out. And although he does not explicitly state the criteria in the trend template, in his book, the accelerating revenues and EPS are certainly requirements. And so what's he looking at here? First of all, he's looking for stocks that are in an uptrend, and he measures that by looking at various moving averages, right? So the 200-day, the 150-day, the 50-day are all above, and they're stacked above each other. So 50 is above the 150 is above the 250. he's looking that the SMA has actually got a positive slope on the 200 for at least a month. So he's looking for, now it's turned the corner, the stock's been in an uptrend, and it's pulling the long-term uptrend, the slowest of all the MAs, it's pulling it up. He wants to see that the stock price is above the 52-week low by at least 30%. And then he also wants to see that the stock price is within 25% of the 52-week high. Now, if you think about what that means, this means that over the last 52 weeks, this stock has moved at least 55% in 12 months. So this stock that he's looking at here has got a range that basically is saying it's moved in the past and it can continue to move. And as Mark says at his seminars, I've attended his private access seminar, if you want alpha, if you want profits in a stock, you have to buy stocks with alpha, and you get alpha by movement. And this is, exactly how one of the ways he filters on. Now, I will say, Greg and I have been, we chuckle because Mark is very prolific in Twitter, and he posts when he's buying stocks. And we have these trend templates set up, and we can watch his stocks and we can gauge the criteria that he's doing. He doesn't always follow his trend template. He's very opportunistic. So just be aware, this is a guide. Sometimes he takes license with his own, Greg's shaking his head there. He takes license with his own medicine here, and he'll take a position on something that may not necessarily meet all of these criteria, but this will get you started, right? So to get you started, Greg and I have we're going to bounce back and forth here today. Greg, I don't know if you want to take it from here, and I can advance the slides for you, but we can talk about FinViz and what to do from that point.
Yeah, sure. So FinViz is and in this screener, it's free. So you can just go in and make an account, and it's all for free. And using the criteria that Minervini has laid out in his books, or you can use O'Neill's, which we'll go into in a second. But yeah, I mean, you could just mess around with each of these criteria, and obviously you can see there's a descriptive field, fundamental, technical, or you could just go into all and mess around with each of the criteria you want to put in. But then FinViz is great because you just get a list immediately. So it doesn't take that much time. It immediately responds with all of the stocks meeting that criteria. So yeah, I think in terms of a free overall screening platform, FinViz is far and beyond everything else, especially that I've used.
Right. One of the things that will frustrate you, in fact, let me do this. So when you get the PDF, this should be a live, I'm going to just shell out here. This should be a live screen that'll open for you. There we go. Maybe. Okay, here we go. One of the things, so I don't have a paid subscription here. In fact, it's not even showing my login here, which is fine. If you do log in, you can save these screens under various names. So that's the good part about it. You can't export this without having a paid account. You can't export this list. You can see there's 145 stocks in this list. So Greg highlighted last night when we were talking, if you click on this charts view, you can actually start looking at the charts that meet your criteria, right? And so you can visually, if you're a visual person, if you're a charts person and you want to start looking at, this is a quick way to screen through and just take a look at what's out there, so ACAM, and you can see where it is in its overall, and we're going to talk about buying right and buy points here in a little bit. And you can see how some of these stocks, meet criteria, and you can get through them fairly quickly. So you can copy the symbols, you can do whatever you want to do. Again, a free account. And this gives you a very good way to scroll through here and do this. So I just wanted to highlight that you can't export this unless you're a paid member, but it does give you the ability now to look at the charts very quickly. You can just keep hitting next and just scroll through them and do whatever you want to do, right?
And I would say also on the type, you see how it has candle, line, or technical, and we've clicked on technical. Yeah, if you go to candle, it gives you now the option to look at a different time frame, whether it's intraday, daily, weekly, or monthly. And yeah, like I said, Finviz is just super easy to use, especially when you're just trying to get through stuff quickly, and it's free.
Right. Okay. So back to this. So if you download the PDF, at the bottom you'll see a link. That link will hot link. It's got all the fields already pre-populated for you. So then you can go and mess around. And if you at least register with Finviz, again, still paid or free account, you can save this scan as however you want to save it, and then you can access it later after you close your browser and come back to it. You don't have to always click on the link to manually set these each way. So that's one way to do this, right? So that's the free way to do it. For those of you with TradeStation, if you're using TradeStation, just simply ask me for the ELD, which is TradeStation's methodology to get into this, and I'll give you an ELD, which will actually help you apply Mark's trend template, and you come up with various stocks here. And then if you want all 134 of those stocks, I've actually linked down here. So you can click on this link again, and it'll open up a file as of the August 28th, yesterday's close, and it'll give you all the stocks that are coming up through a TradeStation scan. But you could do this yourself, and I'd be happy to help you set stuff up. You can see the stocks that are listed here across the top. They had a great week. And last time we did this a month ago, we had the same thing, and they all had a great week. So you sort by relative strength, and you put it out there. You can't argue. I mean, these are good stocks. They're going to get you into a group of stocks that are performing well in the current market environment. And again, having that good selection is really, really important. And then finally, moving to the paid way of doing this, Marketsmith is what I would consider one of the top of the list, not just for what we're going to see here in the list. And I'm not here to sell Marketsmith. I'm not here to extol all the virtues of any one of these. But Marketsmith does make some things pretty easy for you. And if you do have Marketsmith, you can access, I know we had a little bit of difficulty a month ago finding exactly where this was. So I wanted to show you that, it's under reports, stocks, technical, and then it's broken out here in the 1 month. Remember, the basic criteria of 1 month was that the 200-day simple moving average is in an uptrend, and here is Mark's 5-month requirement, which is going to be even less stocks, right? And you can see that, again, filtering down through, these are all really, really good names in the overall universe of things. And I exported this, so if you guys are interested in looking at what Marketsmith is given us, so you can look at Finviz, you can look at what my TradeStation ELD for the trend template has given us, and then you can look at Marketsmith. And so we provided all those links in the PowerPoint, and you can just go get them and do whatever you want to do with them. So anyways, this is the way you can start looking at stocks in the Minervini space and get a pretty good feel of how somebody who's literally his entire career for 38 years has knocked the ball out of the playing field. This is how he's done it, and you're not going to go wrong with adherence to, or at least starting here with these various stocks. All right. So with that said, so that's Minervini. With that said, now let's take a look at CANSLIM. And this is the William J. O'Neill approach of stocks. This is IBD, Investors Business Daily. In fact, using these methods, this is how he created IBD, and it's become the powerhouse in the world. A lot of folks don't necessarily use IBD. There's no sense reinventing something that works, and this clearly works. So I've hitched my wagon. Greg has hitched his wagon. I know a number of the folks that I see going down the list here have hitched your wagons. So I'm not going to have to go too deep into this. I know you guys understand this. But for those of you who don't, this is a great starting point. And CANSLIM is an acronym, and basically you're looking for sales and earnings all above 20%. You want to see annual increases of a pretty good significant amount. You want to see new products, new companies, so IPOs, new solutions coming to the table. Think Slack, think Teledoc, think DocU, electronic signing. Think all the things that would have emerged in technology of working remotely are all candidates under this criteria, because they change business, they disintermediate old ways of doing things, and they bring new ways, more efficient ways of using technology to address what we do in the world. Supply and demand, look for big volume spikes coming in. Use relative strength. So you'll see on a number of our charts that you're going to see here today, we always have a relative strength. We're always talking about relative strength in context of the SPX or the S&P 500, the SPY. Institutional sponsorship, when you see big volume in supply and demand, when you see something operating maybe at 2 million shares a day or 3 million shares, and it goes to 12 or 20, that's not your grandmother buying stuff. That's literally coming in and are making those big purchases. We've got some feedback here. If you could self-mute and want to talk, I would really appreciate it. I'm going to just go on down the list. Sorry for the interruption here. I'm going to see if I can mute. All right, I'm just going to mute. That should help. Sorry for the interruption here, guys. So as Greg says here, this is your money. Why buy businesses that aren't outperforming others, right? You want to invest in companies that are going in the direction of the trade, that are really, really moving forward, and focusing on the stocks with the leading groups displaying strong numbers will help you, get the right mindset within a trade. And then you could actually add to this, and you'll see that we've done that. That's part of that buying, continual buying or buying up as we go forward here. Again, I'm going to turn it back over to my son here, and Greg, you want to walk us through some of the CANSLIM stuff?
Yeah, so we just took the criteria in Marketsmith, which I don't know if you took a screenshot of it, right?
Yeah, so it's coming up. It's on the next slide, actually.
Okay, yeah. So we just took that criteria and we got it as close as we could in FinViz. So yeah, it's just another simple, free way to get pretty much the exact same results. I think the William O'Neill scan in Marketsmith comes up with like 63 names, and this comes up with 55. So, you're going to be looking at the same universe of stocks, and they're all going to be the best names following that same criteria. So it's another free way to just go about it.
Right. And so again, once you get the PDF, you'll see the hot link for this setup, just like we did before with the Minervini approach. And again, if you register with FinViz and save it, you'll be able to save the scan. And all the same things apply. You hit the charts button, that'll take you to the charts, and then you can change it over in terms of candles, and then you can look at all different time frames and visualize it however you want to do it. What is important here is now if you move into the Marketsmith approach, right? So again, this is a paid approach. You have to pay for a subscription to Marketsmith. But this is one of the screens that they have is the William J. O'Neill screen. And you can see that the conditions are out here on the right-hand side. So EPS, so earnings per share, they have a scale that they rank things in. So it's not necessarily a 20% per year or whatever the case may be. They take those criteria and then they look at deciles or the individual, 90 to 100, 80 to 90, et cetera, and they basically put a ranking system that's with all of these things. And so the key here is that it filters down from the 7,785 as it starts applying the different filters here, relative strength, accumulation, distribution from institutions, the change in EPS, the sales change in EPS, the current price over 10, how much is it off the high, et cetera, 50-day average, et cetera. You see where we're going here. It returns 60 stocks, right? So you saw that FinViz here was at 55 stocks. This is at 60. There aren't necessarily going to be a one-to-one. That's the difference between having a free subscription to something. You can get in the ball game, right? You can be in the same playing field, but you may not have all of the same stocks. Maybe that's okay, because actually when a market's doing well, you're going to have a lot of leaders, right? So I'm not at all suggesting everybody has to get Marketsmith, but Marketsmith has many other things that are really advantageous and can save you a lot of time. So there's a balance that you have to strike here of whether or not you want to make that type of investment. But at the end of the day, you're going to come away with a series of stocks, right? And so you can see here that, again, I've just taken, the first 19 stocks that you see here off the Marketsmith, the William J. O'Neill scan. It returned 60. As I said, I got up early this morning to do this, so this was as of 6:40 this morning. So you can see that for those of you who slept in, you missed all the morning coffee that was being consumed. And you can see there's a lot of stocks here, and they all have phenomenal EPS, sales changes, et cetera. They have a composite rating, relative strength rating, et cetera, et cetera. So you can search on all of these, whatever your criteria is, and you can start looking through what Marketsmith wants. So again, another very, very good way to look at stocks. So what I'm going to do here is I'm going to pass this, Greg, I'll just keep control for now, but I'm going to pass the baton back over to Greg, and Greg's going to talk about some names that we've had purchases in or stocks that have been really taken off, and that we made some investments in or maybe are exited out of, but had good setups based upon some of the criteria that we were just discussing. So with that, Greg, mic's yours.
Yeah, so the reason I have a couple more names after this, but the reason I put in the numbers there is to just see, once we see acceleration of EPS and or sales growth, obviously not every company in the world is going to have quarter over quarter of 100 plus sales and EPS changes, but looking at that criteria of stocks obviously, gives you back an incredible winner, and it's only been, 5 months of this bull market or, whatever you want to classify the market as. But Livongo has gone over from the lows, you could see it's probably about 20 up to 130. So it's, 6 times, right? And so, just looking at these numbers will again return you great stocks, and you could see the response of the market to these numbers. So yeah, you just want to go forward, and we'll go through some more names.
Oh, hang on a second. There we go.
Yeah, you're good. Yeah, so D-Dog, another one. We could see incredible EPS and sales numbers. This is an IPO or, a younger stock at least. So yeah, again, I just wanted to highlight the importance of these great numbers, and you could see again maybe 28.50 near the lows, and it's up to 82. So I mean, you get great winners, and it could only take a couple of these stocks to make your entire year in just a quick 5-month span. Go forward. GSX, another one. It's all the same theme. These sales numbers are insane, and then once you see this, once the market understands what this stock should be priced at, it'll respond and explode upwards if it's valid. Chegg, another one, not as big of a mover, but still 26-ish at the bottom, coming up to 72. It's not as big of a mover, and it's still going up almost 200%. So again, these are very repeatable criteria that you can search on and trade. And so finding them before they break out obviously is the goal. And I think you want to go to the next one.
Yeah.
Apps is another one that's already kind of made a quick move, but again, it's only at 23. So the life of this stock is still very young in my opinion, but we'll go one more. XP, yeah. So this is the one I'm talking about just in terms of, great numbers. You could actually see decreasing sales growth, but EPS numbers are still insane quarter over quarter. So we'll see what the market wants to do, but this is another one that has the, it's basing, it's, flat basing, which we'll talk about a little bit later, but the graph looks great, and we'll see what the price does. But yeah, the important thing here is still the numbers will slim down what you're looking at and make it a little bit more focused, so then you can, make the best decisions with your money.
Right. Thanks, Greg. No, that's good.
Yep.
You had one more here.
Oh yeah, we got Zoom, obviously a super winner, but yeah, just you could see the incredible sales and EPS numbers, and obviously the market has responded to those very quickly and very well. So yeah, all right.
Great. Yeah. The thing I'd like to say about Zoom here too is compared to the relative strength of the SPX or the S&P 500 here, you can see it's now, we had a little bit of a basing period here, and now it looks like it's on its way out, way off, not way out, way off, taking off onto another run here. So I think they've got earnings coming up here in a week or two. So I would
Monday after the market.
Okay, so I would be cautious, but nevertheless, be aware. You get some pretty interesting moves after earnings, and if you see that volume signature that we were talking about with CANSLIM stocks, that's something to pay attention to. So when you get an average of a leader that's down here in a couple million, and all of a sudden on after earnings you're up at 30 or 40 million, that's institutional buying, right? They're making big investments into this stock, and that is something you want to pay attention to. This is a classic signature, and this is something you absolutely need to be watching, right? So this is a real key. And all of these stocks, by the way, you can see after earnings how they gap up and they go, and you can see the relative change here in the overall volume, which is telling you they're not doing this in dark pool investments and behind the scene investments. They're making their stance known during market hours, and they're adding big on these earning releases, right? So that's a tell. That's a very, very important tell. So what's your takeaway? What are your action items when you're looking at this? So FinViz, free, Marketsmith, wonderful tools. You can use them. Greg, while you were talking, I looked over at the chat, and Mr. Thomas said, have we charted which ones perform better? Does a cross section perform well? They're all the same universe. And Greg, step in here if you want to correct me or add color here. But where Marketsmith is a paid system, you would expect, and they have more information available to you, Marketsmith is going to be able to help you really hone in on some details. And I know there are some Marketsmith folks on the call here today, and I know you're going to be able to really pinpoint how you use Marketsmith to do these things. And maybe we could have a discussion at some point in the future about the various ways you could use Marketsmith, and the same thing with FinViz. Like I said, in my perspective, FinViz gets you into the ballpark. Marketsmith then helps you refine. You don't need Marketsmith to refine, but there's tools or there's information in Marketsmith that doesn't necessarily is easily attainable in FinViz, and the two together are really good. I mean, Greg and I use FinViz, and we have Marketsmith, so it's just, and we use TradingView. So I mean, you use the tools that make sense for your work stream, for your process. Greg, I don't know if you want to add anything onto that.
Yeah, I would just say both are great. Again, you're going to be looking at the same universe of stocks. Obviously, Marketsmith offers more in terms of overall analysis of a bunch of different industries and things like that. But at the same rate, you're going to be able to find that pretty much anywhere. It's just really easy to do on Marketsmith.
Right.
But yeah, like Dad said, we use both. I think what he said about it, whatever fits your style. I mean, if you're willing to pay, go for it. If you're not, then you're not going to be behind. At the end of the day, you're the one making the buy orders. You're seeing the same stocks, so it's just you have to act on what you see. The platforms just give you the opportunity to act.
Thanks. I think we believe that the CANSLIM methodology is difficult to beat for picking quality stocks, whether they're an IPO or whether they're mature companies, right? So CANSLIM narrows things down, whereas FinViz gives you, the ability to visualize the financial universe. Marketsmith allows you to start focusing, right? So I think you can start doing things that are very narrow here. Back testing with the Minervini trend templates and O'Neill CANSLIM show solid performance, right? So I think that you probably do want to focus on these particular areas. And then the final thing that I just want to leave everybody with as we go into the next section here, you have to work at this. This is not, necessarily a 10-minute a week thing and then you're done. You can get it down, there's no question. And at the end of the day, the more you invest into this and the more you're willing to learn, the better you're going to become at using these tools. So, pick your work stream, pick your amount of time that you have to dedicate, and go from there. Okay, so just a time check right now. We're at about an hour in. We're tracking well here, a little more than halfway through. So this is I think we're on track overall. The next section, position and portfolio risk management. I think this is probably, for Greg and I, this is one of the biggest things that we have focused on and getting our heads around. Once you get this part correct and you couple it with good stocks, your performance will dramatically change. Yeah, so let's dig into this and see what we got. Greg, you wanna run with it? Oh, can't hear you.
Yeah, sorry, I don't know what's going on with my internet connection.
Okay, I'll take it.
Can you hear me?
Yep, I got you. I can take it. So we do believe the most important part of investing and trading is how you manage risk. And so, the key here, the ability to blow up the account is really too easy when you don't really look at in detail at risk. And for this reason alone, you've got to understand how you're buying and how you're selling. And so we look at risk in two primary buckets. The first one is position risk, where you're looking at the individual stock and how do you manage the individual stock. And then we're looking at the portfolio or a group of equities and how do you manage all of that? What's the relationship between those? And it's important, right? And we'll go into some detail here. Position risk starts with buying right. You've got to enter the stock at the right time. If you don't enter the stock at the right time, if you pick an arbitrary exit point or you go with the rules, and we'll talk about what some of the quote unquote rules are, you could get just knocked out instantly because just normal market transitions. So I think that's a big deal, right? So you've got to buy right. Once you enter the stock on what we call a proper entry, if you are wrong, and you will be wrong, you'll be wrong probably more than half the time until you get it right. So big people like O'Neill, Minervini, others have less than a 50-50 batting average. But what makes them successful is they get out of the stocks quickly when they're wrong and they get back into it when they're right, and they know how to ride their profits. So they're not necessarily taking profits. They're getting out of stocks that are underperforming or basically went against what they thought was going to happen. So that's a key thing here. Welcome back, Greg. The next major component of position risk is defining the sell point. And Mike Webster, formerly of IBD, probably he was a protege of Webster, or excuse me, of Bill O'Neill. Just recently left IBD and moved down to Austin, Texas. He says you've got to know your line in the sand. And the bottom line here, you've got to know when to sell the stock, no ifs, ands, or buts. You've got that line in the sand and you do not cross it, period. And as Greg highlighted here on the bottom, accepting risk and respecting it without compromise is the only way that you're going to have a longevity within this overall market. And I think that's absolute key here. So there's many different rules that are out there. We wanted to run through on position management, knowing when to exit. Greg, are you back online able to see everything? All right, I'm not hearing anything from you, so I'll go ahead.
Yeah, it should be.
Yeah, you're
Can you hear me?
Yeah, you're breaking up here, so I'll go ahead and take this. So IBD rules require that every stock position is cut at 8%. And that's just, if you pick up Bill O'Neill's book and you look at it, you know, they're kind of generic stock for the masses. If you're 8% below a position entry, get out. You know, just you live to fight another day. They do caveat and say a proper entry point. And I think a lot of people in my discussions with folks, this proper entry point is elusive, and we're gonna fix that today. We're gonna talk about two proper entry points and some examples of what that means. Many professional traders, and as we've mentioned here today, O'Neill, Minervini, another protege of O'Neill named James Ropel, who runs a hedge fund, Mike Webster, who I've already talked about, they cut their losses way earlier. So Minervini, if you go to his webinar, or his seminars in South Carolina, he's got the mathematics and the records to show that his average loss is about 3.5% across all of his stuff. And remember, he loses more than he wins, but it's only 3.5% average. And he knows these numbers. He's very, very religious about recording everything. O'Neill, he cuts many of his positions way before they've dropped to an 8% loss. So he starts scaling back much, much earlier. He doesn't wait till they go to 8 and then get out of there. He actually starts taking money off the table right away, or when he was trading. Now he's retired. James Ropel, in a number of webcasts recently, he follows this 3, 4, 5%. So basically, he takes roughly 50% off at 3% fall, another 25% off at 4%, and then finally will close out by 5, making his average loss somewhere around the -4. And that's generally where he tries to sit in. And he does the scale out just to stay in there in case he didn't get an exact entry that he was looking for, and he doesn't get shaken out. And then Webster, the other protege of O'Neill, he starts to unload. He has a ranking system using IBD and Marketsmith that he says, C-rated stocks, B-rated stocks, and A-rated stocks. So if Webster were on the call right now, he would basically say you've got to rank your stocks and you've got to assign them a letter grade. And this letter grade is their performance and how they're behaving in the current market environment. And he starts to unload his C's before he unloads his B's, before he unloads his A's, and he raises cash very, very quickly. So I think the key here is that there are different ways to approach this, but you can see the masters who have really looked at this, again, with this proper entry point that you see at the top, and we're going to get into this in a second here. They're out relatively shallow. And this, for me personally, has been a very big paradigm change, especially as an options trader, because sometimes I would let especially on uncovered calls, cash secured puts, I'd let it go down a little bit more because my put was typically lower than the 8% lower. Now I've changed my philosophy on selling cash secured puts and how this works, and you'll see why you can actually pull that bottom up on a CSP and not have to be down more than 8% on a given position. So when we talk about buying right, or this proper entry point, what does that really, really mean? Well, the only way you're going to place that line in the sand, that stop loss of 3 to 4%, without being whipsawed out. And whipsaw is when the market comes down below periodically, and it cleans out, it tests everybody's stops, and it basically takes you out of the picture. Is that you've got to buy right. You've got to buy where the risk reward is already built into the overall framework. And we're going to go through some charts here that are going to show you as examples of what that means. There are numerous entry patterns that are available here. The two that I'm going to focus on today and that I'd like everyone here to focus on are what we call the flat base and a pullback. And I've circled them here. This chart that you see here on the screen, I put in the Dropbox folder, and you can download this chart. And basically, these are different methodologies of buying right, or buying at the proper points. We're going to talk about the flat base today, and we're also going to talk about a pullback, which I think are key. The overall key here is that the risk reward in these two setups, well, in all these setups, but in these two setups especially, is no greater than a 2 to 4% loss. If you can master your entries using these two setups, you don't have to do all of these. if you can master it using these two, there are plenty of stocks who adhere to this, and you're going to be buying right. And that's going to enable you to set your line in the sand, which is then going to give you confidence that if it hits that stop, you're on the right side of the market. So let's take a look here at a few of these. And let me check and see if Greg is back online here first. If he's not, let's see here. I know he was having some connection issues. I'm going down the attendance list. Oh yeah, I do see Greg. Greg, are you there? We just don't see video. Yeah, okay, Greg, are you there?
Can you hear me?
I sure can.
Okay,
Can
cool.
you see the screen?
Yeah, I can see the screen.
Okay, so I've got Zoom up for you, and if you want to take it from there, or if you want, I can pass control over to you, however you want to proceed.
We'll just keep it here for now, and then if we do charts later, I'll take control. But yeah, so going off, making sure we get good entries and proper risk to reward entries. For Zoom, this is one that I've been trading for the past 2 weeks or so. But while all of the leaders have been getting hit throughout the end of July into early to mid-August, we see them start to base after their huge runs off the March lows, which is completely healthy, of course. But we do see Zoom. This white line here is the 50-day. I don't know, Dad, if you want to highlight that with your mouse.
Yeah,
yeah, there you go. Yep. So with that, you get that break on increased volume of the 50-day. So, you're not buying there. You're not buying right as it touches the 50-day because you don't know the direction. But once it makes its mind up and then breaks back on the 50-day, so I put an entry on right above the 50-day. I saw relative volume on the day was increased, so I put a position on. And then by the end of the day, with a super strong close, I added to it. So you can see my notes here. Long at 252.30 with about a 10% equity position. It took over the 21 EMA. It took over the 50-day EMA. I don't have the 21 put into the graphic, but they were converging, so that's another point of emphasis in terms of good risk to reward. And it took it all on volume. So in terms of the leaders that were basing, this was the first one to actually have volume come into it. So that told me, like, all right, well, maybe this will be a sign of change of character, but I have to be dumb and follow the price and volume movement, no matter what the rest of them are doing. And then we could see I took another add at the end of the day at about 260. Again, same rules, took over the 21, took over the 50, and volume was confirming the move midday. So total end of day one, I'm at a 15% position already, just because my cost basis is going to be right on the 50. And I think, it's a very good risk to reward area. Next day, there was a follow through even higher on almost average volume. So I took a little bit more. I added a little bit more. And it also is breaking this white downtrend line. So, there's multiple converging entry points and things like that to go for. But, this stock so far has been acting completely well. And then the following day, you have a decreased volume and kind of not an inside day fully, but the character of an inside day. And then the following day, breaking to all-time highs on volume through the point of resistance at 281. I went a lot bigger, 12% addition, and then that was right on the all-time high. And then end of day, volume was tracking to be huge. So I added again. So I'm currently very overweight in this name, especially with earnings. I'm going to be reducing significantly, but I really liked the action. And, you could also see the following days, they got a test and a shakeout because it closed, or it went down below the pivot point to the downtrend lined area, touched it, and closed back up about 50% of the range, maybe a little bit less. But still, to me, that was just a quick little shakeout. I held my shares. My risk was still in check. And then the following day was actually a gap down from the previous day close and then a close above the pivot. So again, I'm thinking, all right, higher or sideways is what's coming, and it's moved slowly higher into earnings. So, from the original 50-day entry, it was up about 20%. So that's going to be enough for me to hold those shares into earnings. I'm going to reduce the majority of the ads. But yes, the main position, about the 18% position, will be held through earnings just because I have the cushion, and I'm going to take profits on the rest. But yeah, so this was just a very good example of the risk to reward on 3 different aspects. You got the 50-day, you got the downtrend line, and then you got the all-time high breakout. And you know, it's with the retest in it as well. So this stock has been acting really well and a true leader.
The next
Go
one.
to the next one.
Yep, Peloton.
Yep. So Peloton, again, while all of the leaders were basing, it was kind of the same deal. I saw Peloton break the 21-day on volume in the morning. So I was like, okay, well, I'm going to be dumb and follow the price. So those are my rules. I took a 6% position because, again, I was a little bit worrisome because I had just raised majority cash, but this started acting right. So I immediately put it on. It actually came down below intraday, my entry point, not 2%, but still below, or 3%, but still below. And then by the end of the day, it finished very strongly on volume, so I added more. Yeah, we can see I got long at 65.64, the 6% position. Like I said already, those are criteria. And then at the end of the day, I got long at 65.77 with a good add. So again, I got to about a 18% equity position right off the bat. And I have not taken any heat on the average cost since. Heat meaning, you know, any sort of drawdown past 2 or 3%. So yeah, and actually we can see on this, I have this highlighted, the reversal on increased volume compared to the previous 2 days led me to sell 20% of the position because I just wasn't loving it. And then of course right after, it gets an upgrade from I don't know which fund or whatever, but yeah, so it gaps up, shakes out and closes the gap, and then closes back up. And I didn't add immediately on the open because I wanted to see what it would do. Then I got long at 71.18, another add, and yeah, and then I was expecting it to go higher once that shakeout finished, and then I added again yesterday. So again, all of these start with a very strong risk to reward off the 21 or the 50 with volume. And then once they break to all-time volume, that gives me more conviction to add, especially as it starts to run into earnings, which I think are in the first week of September.
Yeah. Maybe second week.
And then we'll go.
Somewhere in there, yeah. And then pins, yep.
Yep, and then we have one more. So pins was an earnings gap up, huge volume, was the highest volume it had traded ever. So, you know, that immediately gets on my list. Yeah, so to barrel, have you got separate stops for each ad? Yeah, so each ad I'm gonna cut at about 3% loss, and you know it's gonna be depending on the volume characteristics and stuff. But yeah, every entry I have is gonna be 3% loss, 3, 4, 5% losses, just to keep risk in check. But yeah, so back to pins. You know, you get this open on the gap up high was 33.56. And you get a touch on it about 4 times, and then a shakeout close below to, you know, rid the weak hands potentially. And I actually got long on a bounce on the 21 EMA. So at 32.77, I took a 15% position right off the bat because, again, my risk to reward there is pretty much I'm going to be stopped out at almost 0% loss. It'll just be right under the 21. So I'm willing to put size on in those, you know, positive risk to reward areas. The following day, the bounce was confirmed, so I added more. And then, you know, it's kind of been meandering on the 10-day. And then yesterday, I added huge, again, because the risk to reward, my cost basis will be right above the 21. It'll be maybe 1 or 2% right above. My stop loss will be right below the 21. So again, I'm not risking anything over my overall equity on the position and account. So yeah, I'm overweight again, and I'm just waiting for this to decide a direction to all-time highs. But yeah, I'm gonna keep a tight stop on that second ad that I had yesterday because it's a pretty large ad. So I'll probably cut that, you know, 0.5% below, whatever. But yeah, so. Still waiting for this to get some volume to all-time highs, but I'm positioned well. I have a good cost basis, and my risk to reward is hopefully going to pay off with a you know, continued move in the markets and this stock.
Right. Yeah, and Beryl, I see your question. You know, is the strategy always stock as opposed to options, or have you got separate stops for each ad? So the second question about the separate stops. So Greg has opened my eyes to, instead of taking the net basis for the entire position and then doing a 3 to 4 of that, he convinced me this week to actually look at the individual ads as their own individual buckets, right? So having a stop for each ad will preserve the original, even though, you know, TradeStation or Fidelity or E-Trade don't necessarily account for it that way. We have paper accounts in a Google document that he and I share, and we're able to track that very exactly. So I think the answer that you're looking for is yes, it's probably beneficial to separate the ads from the original base and do all your stops based upon those ads. And that way, if you do undergo some heat, you're not necessarily getting completely out of the position. Now, I will say in a money management scenario, this is not what Minervini or not what others specifically do. This is kind of our own flavor on how to manage this, but we're liking this. How do you add to a position once it starts proving itself? And this is one way that you can do that. To the question, all right, I'm being told they're having a hard time hearing me. Can you hear me better now? All right, let me try to see if we can get this going here. To the point of the other question, is it always stock as opposed to options? I'll show a couple slides here where I've got some options that are in the overall mix. I'm not going to show you the options per se. I don't have charts prepared for those, but I can denote where I sold a call against it or whatever, just to continue to lower my basis. So yeah, I think that is, you know, it says something is blocking my mic. No, it's actually the same thing here.
Volume's fine on this end.
Okay, all right, I appreciate that. So let me go on to the next slide. So the three that Greg did are relatively on his side of the trading. Remember, he uses TradingView as his primary platform. I use TradeStation. Same concepts, the exact same concepts. So Sunrun, I don't know if you've been watching the solar stocks, but the solars have been doing really well. And what that means in the big picture of things, Sunrun, Vivint Solar, et cetera, who actually is being acquired by Sunrun, has been doing pretty well. So earlier this week, I went ahead and on a flat base, you can see the base was forming here. We had this Darvas box that formed here. And basically, as soon as we took out this high that you see here, I went ahead and placed an order for 100 shares. Now, that 100 shares should be a kind of an antenna that goes up for those of you who trade options. I actually did sell a call against this at the same time, further lowering my basis. And you know, I wasn't expecting it at the time that we would close above 55 by Friday. You can see that we actually did close at 55.51. I didn't want to get called away on this, so I actually rolled out to 75 on this particular stock. So I'm holding the base at 100. And I've got a call out there now at 75, and I'll just keep rolling out forever. I think my basis on this thing is you know, down in the around 52 now or 53, so it's working out very, very well. So I not only rolled up, but I rolled out in time there. Next one is Square. I don't know if you guys have been following Square, but Square's been doing some phenomenal things, and I'm not showing the full chart here, but you can see another basing period that we had here. I went ahead back here on the 17th. I had bought off of the bounce here. You can see that it was adhering to the 10-day very, very well. It took off. I didn't actually buy until the end of the day. Wanted some confirmation that things were going on. But again, we had higher volume that was going on. Then we just progressed through. You can see a Darvas box formed here, coming across, and now we're still basing. And then the other day, on Thursday, I went ahead and placed another order, only increased it up another, I think it was probably 20 or so shares, just adding to it a little bit. The bottom line here, though, is you know, my fill isn't the greatest, but nevertheless, you know, it was on higher volume, and you can see that it actually moved ahead on Friday, and it's going to continue up. So I'm going to continue to add to this as my risk reward allows me to do so. And you know, I think in the big picture, you know, this is also going to be a good one. And then finally, Roku is another one that's been doing very well. This has got both a pullback and also a flat base breakout. So the pullback here, you can see the convergence of the 10 and the 21 on higher volume. So I got in here at a very good level. We had a volume, you know, some higher volume on this day, but not as high as the prior. So some, you know, inside day fully. I went ahead and added a little bit on that inside day, and then finally, you can see here that we had a flat base breakout over on this Darvas box here, and boom, now we're off to the races, or maybe off to the races with a really good cost basis. So I'm pretty happy with this. A significant volume, you know, average is 9 million, and on Friday we had 25 million shares exchange hands. So you know, almost a 3x on that particular one. And then finally, in this last chart, just showing another flat base and pullback. So we were pulling back. I fell underneath the 21 on Peloton, as Greg had shown in his diagram. It retook. This is the exact same scenario, same days. It retook the 21, so I added in there. We had a little bit of a, you know, the next day was down, but it was on lower volume. And then you can see I added again. So I had 100 shares here, 150 shares total here. So I added 50 here on this breakout above this box level here. And then finally on yesterday, we took more as we cleared this level here and added another 29 on top of that. There's a nuance here that I want to indicate. Part of what we're doing is we're managing the stop level of the position. You can see the break-even line is now below the 10-day. And this has been adhering fairly well, at least to the 21-day. So when we either separate the individual trades or look at the new trades, they're all falling within, you know, the risk tolerance that we've been talking about here. So I think, you know, there's a way to manage these positions that if this one does start to pull back, for instance, you know, be able to give up those 29 shares as necessary, you know, kind of unwind the position back towards what the original basis is. Again, even though the brokerage platform doesn't look at it necessarily that way, this is how Greg and I are managing these positions. And it makes sense to me because, you know, these are good stocks. They're, unless the behavior changes dramatically, and we're going to talk a little bit about that in terms of trend following, unless the behavior changes dramatically, there's no reason not to continue to hold on to these stocks. Let's see here. All right, so that part was looking at the overall position risk management. I want to shift gears just slightly and talk about the overall portfolio. In fact, Greg, do you want to handle this since you prepared most of the background on here?
Yeah, I'll go for this. So the way I've taken, or the approach I've taken towards managing the portfolio is that none of my stop losses that are hit should be more than 1% dollar amount of my total equity, and that means, you know, I'd have to lose on 100 straight trades to go to zero in my equity balance. So and there's a couple ways that people position size, but if you want to, you know, go this route, there's the dollar risk amount, and you could just do the dollar risk divided by the buy price minus the stop loss price. And that'll tell you how many shares are allowed for the position to be within your 1% of total equity. So in the numerator, we see the dollar risk amount. So that's just going to be equal to your 1% of total equity. So if you have like I said, 100K account with 1% masked dollar risk per trade with a buy price of 100 and a stop loss of 4%, your 1% max risk is going to be $1,000, and then yeah, you see the equation. So yeah, you can do this with any account size. Obviously, it's going to be easier with a bigger account to get more shares in, but it's still equivalent to the actual it's still scaled to the account. But yeah, so you don't need to buy everything at the same time. You can scale in, and we've shown that a little bit. But you know, those aren't necessarily I forget the word, but you know, just what Minervini, like Dad said, Minervini or O'Neill would necessarily do, but you got to put your own flavor and feel into the market. So, you know, scaling in and scaling out is more of an art than a science, but it still can be profitable if you do it with risk in check.
Right. Yeah. No. And you know, I think, you know, the one thing that we don't have on the slide that I want folks to realize, if you end up buying 250 shares and, you know, they're $100 a share, right? You spent $25,000 in the account. So you're 25,000 in the account on a 100,000 account. That's only going to allow you, in this particular case, that's only going to allow you approximately 4 positions. And we're going to talk about this next month. You may think 4 positions is crazy. You wouldn't necessarily want to start there, and that's why I think scaling in is important. But it's not unreasonable to think you could end there. And if you're managing risk correctly and the stock is behaving, it's not unreasonable to think that 4 positions as you're running and as the stock is firing on all cylinders and the power trend is turned on, and, you know, and there's a lot that you can do here to really start getting these gains that these major players are getting. So just be aware that's how these numbers work out. I don't think you need to buy, you know, jump in with all feet, you know, into the deep end, but certainly as your risk tolerance and confidence in the performance of the stock improve, adding to the position and managing risk in terms of the overall position size, this is one way to approach that. So let's summarize what we have here. So, you know, a mandatory rule. You have to do this. Know your exit before you enter. You've got to know your risk reward. Do not get in if you don't know where you're going to get out. It's that important. Once you've determined that, your entry shouldn't be any more 3 or 4 above that exit point. So if you're taking the SMA or the EMAs as you're going to put a stop just below those, which you may or may not do, or the bottom of a Darvis box or something, then you know where you're going to want to get into this. Now, if you go above that, if you're 3 or 4 or 5% above that, you run the risk of a pullback actually shaking you out. So just be aware that that could potentially happen. When you're looking at these charts, I hope you're taking away that look for support levels and price adherence to those psychological levels. It's not that the 10-day or the 21-day EMA or the 23-day EMA or the 35-day or the 50-day or the 65-day have anything special to do with the stock, but the market uses those as psychological levels. And so the key here is you're looking for a price adherence once you get to these psychological levels. So it's once you start seeing a tail come down off of a candle, touch a moving average, and then go back up, that's a tell. If you see a price open below a moving average, but then close on volume above the moving average, that's a tell. Our favorite in this current market is the 21-day. The 21-day has been adhering very, very well, or stocks have been adhering very, very well to the 21-day exponential moving average. And I would urge you to look at your stocks in this lens that you have up on the screen right now: a 10-day simple, a 21-day exponential, and perhaps a 50-day simple, just to see where the convergence of the different moving averages are. And then as Greg just highlighted, your position size should be no more than 1% of the total equity in the account, and the chart that we had on or the equation that we had on the previous slide. All right, so entering the last section here, and again, a time check. We're at the bottom of the hour, so we'll be wrapping up here probably within the next 10 or 15. Just a few more slides to get through that I think will be important for you. So the importance of the trend. This was actually a highly ranked item to talk about within the group, and we're happy to put some ink on the screen here to do this. Again, from Marketsmith on 8/28, yesterday's close. the market pulse, market snapshot, it says, current outlook, the market is in a confirmed uptrend. Well, what does that really mean? What does that entail? So this is Marketsmith. This is a paid, service. How would you go about doing this if you didn't have Marketsmith? Or, what does it mean if it's not in a confirmed uptrend? What does that approach look like? And that's really what we're going to focus on here as we wrap things up here. So what is a confirmed uptrend? That's specific language that is what's called inside language at IBD. It's something that Bill O'Neill coined together and has stuck with the company for all these years. It requires two things: more inside language called a follow-through day, which is IBD terminology now that has been adopted out into the industry. And then the slopes of major moving averages are pointing upwards, and we're going to talk a little bit more about that. The first thing that's a lot of confusion is this thing called a follow-through day. And so during a rally off of a local floor, you get price action that bounces off. So think of what happened in March and on an index, and then a big volume action that actually propels us upwards. And it generally occurs around day 4 because there's a lot of shorts in the market and they have to get cleared out and they have to cover. So roughly starting on day 4, but as Greg pointed out in a conversation this morning that he and I were having, it could go all the way out. William O'Neill's view, it could go out to around day 17. So a follow-through day is off of a bottom on volume that propels you higher than where it's attempted to go through. And you're going to see some charts here that demonstrate this. And you may see a retest of pushing through resistance. In fact, that's exactly what we had coming off the March lows, and you'll see that exemplified here. So here's an example of a follow-through day on the S&P, and it's obvious once you see it, but it may not be so obvious when you're living it on a day over day. And this is why you have to start training yourself to look for these things. So you can see on the left here, we're coming down on the S&P 500 in March. This is March over here, and we hit the bottom on March 23rd. We start up, and you can see there's a huge volume day where we've got these three price days that are successively up on much, much larger volume. Not as big as the down volume with the pink bars that you see in the previous days, but significant. I mean, these are consecutive days. So this should be your radar should be up saying, oh, we're really trying to rally off the bottom. Now it could fail and become a lower W, a double V on the bottom, or it could do what we did here. So we come up, we bounce around, we keep trying to get through this resistance level. And I've drawn this artificial line here. And the artificial line is just purely where the price action kept bouncing against it on not necessarily on the down days, on lower volume, but it was trying to push against it. And then finally, it failed. You can see that the price action fell down on lower volume, and then we tried another push through. We got the push through, and it actually took out that resistance level. And this, clearing that previous resistance on the higher volume on an index, establishes one of the key cornerstones of what a follow-through day is. So this is on the SPX, as you see here, the S&P 500. Let's take a look at the NASDAQ. The NASDAQ, different, it's not a mirror image, but it's the same coincident day, right? So on 4/6, we had that same basic action. We came up, we had some resistance in this area, depending on where you draw it from the high here, you draw it from the closes here, it doesn't really matter. We cleared it on 4/6, and then you can see we've never had any heat at all. We've never come back to that level since then. And so that was on higher volume on 4/6, and it's been off to the races as we've talked about. So the follow-through day establishes one of the key criteria. The next criteria is that we want to see the uptrends of, basically the psychological moving averages, as Greg and I call them. I mean, these are the key moving averages that, the money managers of big industrial funds are looking at, et cetera. And those are the 21, the 50, and the 200s, and predominantly the 50 and the 200s. If you want to get in a little bit earlier, if you're a little more risk tolerant, you can take a look at the 21 and start acting on things. And so the next part of this then is starting to look at how these moving averages come together and how they form the basis of a trend. And this is not a black-white thing. What this is this is a building confidence as more and more confirmation is established in the market. So as we said, on 4/6, we cleared previous resistance and the 21-day EMA. So here's the 21 that's coming down in purple. You can see that we cleared it, and you can see back here, by the way, that we actually tried to get through it in the previous tests, and we failed, right? So now we're coming down, we're still, the price action's down, it pulled the 21-day EMA down, and then we punched through it, and you saw that earlier that was on higher volume than what we had seen earlier. That's a signal, right? That's your radar is now looking that an index has now punched through on a major psychological moving average, the 21-day EMA. The next thing that occurs is when the EMA crosses the 50-day. So this yellow is the 50-day EMA on the S&P 500. You can see that the purple, which is the 21, now crosses it from below. This is another key enablement within the overall structure. It's not by itself. It's not saying, okay, we're out of out of the danger zones, but we are definitely looking at something that is a positive thing. I also have a green arrow here where you can see that the S&P actually came down and the tail touched the 50 or touched the 21-day prior to that. So we had a test of the 21 and then it took off. And that's important, right? When you start testing against these moving averages, it shows there's movement into the price action of the index, which is now broader based in the market. And then finally, a couple more things here. We get a turn of the 50-day, so we're already positive on the 21. We get a turn of the 50-day right around 519. And then on 6/2, IBD has something which they call the power trend, and I'll talk a little bit about the power trend here. This is a confirmation to step on the gas, right? This is a confirmation that you are in an uptrend. You can go on margin, or you should consider going on margin because you've got a lot of things going on here. Now, it doesn't mean you're not going to retest. It just means all the conditions are right until they're not. Don't forgo risk management. Don't forgo any of that stuff. But now you've got basically free and clear, and now things are looking really, really good in terms of various confirmation of the uptrend. So this is the SPY or the SPX. Let's go ahead and take a look at the same thing with the NASDAQ. And you're going to see it builds pretty much the same way, a little more aggressively or a little more early here. Again, 4/6, same type of animals. We tried to test a couple times, didn't necessarily make it above and stayed below above. So you can see the red arrows that I put there. On 4/21, we get this crossover that I was talking about before, where the 50-day basically it holds on a retest where the stock came down. You can see the wick just touching the 50-day, and then you can see on 4/24, just 3 days later, the 21-day crosses the 50-day from below. That's a positive sign. And then finally, on 5/6, we get a coincidence of things. We get the 50-day slope turning positive, as you see here, and we also get this IBD power trend turning on, telling us that the NASDAQ is in great shape also. And this occurred, by the way, just if you take a look at it, that was 5/6, 6/2. So we had the NASDAQ signaling a positive entry into the markets. And these are things that we should be looking for as we go forward in terms of confirmation of the trend. So it builds over time here, and I think that's important for everybody to understand. So let me talk briefly as we wrap up here about what is the IBD power trend. Mike Webster, who is, as I said, one of the proteges of O'Neill and has just recently departed IBD after 29 years, I think it was, or 21 years, calls this the gas pedal. The IBD power trend is basically a set of criteria that I've laid out here in green, where you're putting your foot on the accelerator. And so I don't have to go through all these, you can read them yourself. But the key here is that once that turns on, they've done a significant amount of testing across decades and decades of data, indice data, to come up with this. And so this is not something I created. This is something that IBD is behind, and they will advertise, or they do advertise. Mike Webster has talked about it considerably in his discussions. And as you saw in the various presentations, charts that I had up before, the power trend is on right now for both the SPY and for the NASDAQ. Now, it doesn't mean it can't turn off on Monday. I want you guys to be absolutely clear on this. It can turn off at any time, but it's been positive. And so I think that's something that we need to watch, and I've coded it up in TradeStation, and now I have it on my screens, et cetera, et cetera. The IBD criteria to turn off is a violation of the on criteria. So if you get a violation of any one of these things, or an index close below the 50. If we get a price close, it doesn't matter what the others are doing. If we get a price close, like a gap down of the 50-day, you're going to be out of there, and it's going to turn off, and then everything's going to reset until it, you've got 10 consecutive days and 5 consecutive days of stuff. So you're going to have to, you're not going to see whipsaws necessarily with this. So what, as we wrap up here, what is an uptrend really looking for? It's a confirmation, really builds in stages. You're looking for that follow-through day. You're then looking for the primary moving averages, those psychological moving averages of the 21, the 50, and the 200 to intersect from below. You want to see them crossing each other and moving up. Some call the 50 crossing the 200 from below a golden cross, and it's a major milestone in what a lot of funds look for and things like that. Look for the slopes of these primary averages to be pointing upwards, to be positive. And then finally, look for that power trend confirmation. So that's a possible signal to go on margin if you have margin available. On the flip side, since we're already in that mode, we have to be looking for what's the downside, what's a downtrend look like. And it comes really in 2 stages. That you need to be aware of and we need to be looking for. The first one is a change in behavior of the index. So you can see, let me go back here, you can see on the NASDAQ, for instance, that we keep coming down to the 21, we hold it, we come down, we close above it, we come down, the tail's below it, we close above it, we're below it, we get some weakness here, but then we walk along the 21 here, we're adhering very, very nicely. We came down to the 21. You can see that the 21 for the NASDAQ in this market, a close below is a change in behavior, right? So you would close below, but we resumed. We close below, or open below in this particular one, but we resumed. So you can see that in this context, a change in behavior would be a condition of getting off margin, possibly taking in some gains, things related to that. And then if you see this change in behavior, that generally the state then goes to a confirmed downtrend where you have a failure of a psychological support, and that's typically your 50 or your 200. So the change of behavior, as I was just talking about, if you were observing repeated retests of the 21 and then it closes below the 21, that's your warning flag, right? Now you've got to get serious about money management. What do? You take your foot off the gas pedal, get off margin. You raise cash by selling those C-rated stocks, B-rated stocks, whatever the case may be. If that continues to fall or fail, then you're in a confirmed downtrend. The index will close below the 50 or below the 200. Cash is king. Develop your watch list. Start looking for the next leaders. They will emerge prior to an index. Now, remember, an index is made up of the behavior of the market, whereas you're looking for leaders to start emerging. The leaders always lead, by definition, the indexes. That's what they do. So you need to be vigilant. You need to start looking for the next leaders, start looking for the next confirmation day, the turns, the bottoms, and all those things that we haven't gone into great detail on, but I think you've got the idea here. So what's the summary on the downtrend? It occurs faster than an uptrend. Get off margin, move to cash. It's really that simple. And I think I've given you some ideas on how to do this. Now, some other screens that Greg had prepared. Greg, are you still on? Oh, I think we lost.
Yeah, can you hear me?
Yep, we got you. Yep. So last slide here.
Okay, sorry. Okay, yeah. But I just have some ones in FinViz that I've created, and this is an EPS and sales screen for greater than 30% quarter over quarter. Yeah, and we showed this earlier with William O'Neill's Marketsmith screen, and then I also think this is a very beneficial exercise to do, where you look at the stocks that have doubled this year alone, and you can go through and add certain criteria to see, you know, which ones have strong EPS and sales numbers, and you study those to see if you can catch the next one. So yeah, I think that bottom one is super beneficial as a study tool, and then the top ones can help you find current stocks.
Okay. Well, guess what? We have made it to 1 hour 46 minutes into this, and for those of you who have stuck around, which looks like everybody except one, thank you. I appreciate that. It obviously takes a lot of time to put something like this together, so I appreciate everyone sticking in there to the end, and glad you find it useful. That's the biggest thing for Greg and I. As I said when we started this this morning, we'd love to take you know, your questions if you've got them. Feel free to go on mic and ask, or you can write them in the chat box, whatever works best for you. Additionally, we're happy to look at individual symbols. Greg, you want me to pass over to you, or you want to do it here? And
yeah, you can pass it over. Let's see if my connection works.
Gotta love technology, right? All right, so I'm gonna pass you, presenter. Here you go.
Okay, let's see if it works. Share.
I got it.
All right, can you see it?
I can.
All right. So yeah, Beryl asked about Stamp, STMP. Just looking at this chart, I drew a quick little, I don't know, you could say all-time high point of resistance line back in May, just to, you know, clean things up a little bit. Yep. But yeah, so we can see it had a pretty huge earnings pop here that seemed to be sold into pretty heavily, as we can see these volume bars afterwards are pretty high, and the price action confirms the downward movement. So while they were great numbers, you know, you have to trade the price. So as it fails to break above this orange 10-day SMA, and then now it has lost the 21 EMA on a little bit increased volume, not quite above average, but still on increase. And then the inability to take it yesterday shows me that this stock may need some time to, again, digest the earning numbers, figure out where it wants to be priced. Let's see where the 50 is below this, so we can kind of get a gauge as to how far it may drop before finding some support. It's looking like about 8% of a drop. Yeah, it looks about 8% drop, and we could see back in, you know, June that throughout this time it kind of respected this area. So that may be the next point of support it's going to get. I wouldn't trade this until it moves to the 21 and the 10-day kind of convergence on some volume to show that there's some institutional demand behind this name.
Yeah. Good.
Let's see if there's anything else. Wayne, what, if any, market internals do you review as you consider market strength? That's a great question. Dad, you want to go to that?
Yeah. You know, so, and I don't want to, it's not an easy answer. And the reason, Wayne, is the environment we're in of low interest rate is important. And what the Fed did this week by committing on to keep inflation in check, or to keep it low by not raising interest rates, means, and this is one of the internals that I think you're alluding to, is important, because that's going to fuel home starts. So I anticipate a continuance of mortgages and all that goes with that, right? And so anything that's related to building residential loans, anything that would benefit in a low interest rate environment, I think would be something that, to me, is a risk on type of approach, right? So for those of you who remember when Ben Bernanke and what happened, you know, during the 2008, 2009, 2010 debacle. They called it the Bernanke put with the quantitative easing. And we're kind of in that same environment right now where we've got the government basically writing a put to keep the one in an election year. And I'm not going to get into politics here, but because we've got the government putting a lot of money to keep the economy going, and we're going to keep interest rates low, that's a risk-on environment because it's not going to make sense to go to fixed equity when you can get the gains you're getting in the equity market. So we're going to continue to see things, at least in my view. So interest rates is one of the market internals that I'm looking at. And then the other one is what I had earlier, where I was looking at those trend lines on the major indice, that regression line. And I'm looking to see that we adhere to this movement we stay within those regression lines. And that's telling me that the markets, for whatever reason, the markets are behaving with the same amount of money that we saw before. If we start seeing each of those roll over at the top and break on the lower side of those regression line, standard deviations or standard errors, that tells us that, you know, money's coming out of the market. And I think that's going to be very, very important. The other part of this, though, I think is important, is looking at, there's been a number of gold stocks and silver, of course, and, you know, platinum and all the precious metals have been pushing to newer highs. Typically, those are hedges against inflation, and typically those are hedges against a weakening dollar. And I think we're seeing with the printing of money, and we're seeing an inflow of money into like Barrick Gold, et cetera. We're starting to see more and more influence there. And although I don't have, neither Greg nor I have any gold stocks right now. We did play with GFI, I think, for a while. But the bottom line is I think while precious metals, we're seeing a rise in that particular area, it's disconnected from where we've seen it in the past. We've typically seen it on a weaker dollar, and as a defensive play. I'm not sure it's appropriate now with the put that is being written by the U.S. government underneath the market. So, your crystal ball is as good as mine, but I typically look at that, and I have chosen not to participate in the gold players only because they're not. I think there's better opportunity elsewhere, and they've been very volatile. They haven't followed necessarily the psychological EMAs or SMAs that I've been talking about prior. Okay, let's see, what do we got here? It looks like NVDA, Greg? Oh, you already got it up. All right, you beat me to it. Go for it. Nope, you're on mute. Or maybe you're not. Lost your audio there, Greg. All right, looks like we've lost Greg's audio. So let me take a look here at what we've got here. Oh, he was sharing and now he's not sharing. So let me call it up. Hang on here a second. Share my desktop. Let me go over. All right, so here we go. You guys should be able to see this. And now let me just get out of the presentation and go to the desktop. And let's call up NVIDIA. Let's go here. All right. And I'm
back in. Sorry, Dan.
Yeah, no problem. I'm actually just bringing NVIDIA up on screen.
Okay. Yeah, I have it up too if you want. We'll see if it works.
You want me to pass control back to you?
Yeah, I have it up, but I mean, if it doesn't work, I'll sign off and that'll be that.
All right. Well, here I'll just. I'm going to pass control back to you, and we'll go from there.
Okay.
All right. All right, you got to display your screen. There you go. Perfect.
Okay, can you guys hear me?
Yep, we're good.
Okay. Yeah, so I don't know. Is it still working?
It is
Sorry.
working. Yeah, we do see the screen. Are you having troubles?
Okay, I'll see if this just works or it doesn't. But yeah, so NVIDIA's got a bunch of times on the 21. I have them all blue arrowed out, but it's respected this level and closed above it the entire run up, basically from the April 6th follow through day. And we could also see, I don't have the earnings numbers displayed, but I'm gonna imagine they were good considering these huge volume bars after the earnings dates were, or after the earning report was released. So yeah, this is just a super strong uptrending stock. It kind of just, you know, continually makes all-time highs as well as relative strength all-time highs, followed with volume as well. So yeah, I would not initiate personally if I don't have a position. I wouldn't initiate one here. I'd want to see it kind of go sideways for a little bit before it breaks out, especially as it starts to get close to this, you know, upward trend line. Trend lines are a little bit more of an arc, but yeah, just as an area, we could see it touches it, sort of pulls back, touches it, goes sideways. So maybe some sideways movement, or maybe it continues to break out. But yeah, I wouldn't initiate a position, but if you're holding to a position here, you just, you know, continue to ride the wave.
Right. Yeah, and I've got I opened up Marketsmith on NVIDIA. July numbers for EPS were 76% change and a 50% change. So it actually did phenomenally well, and it's a little bit of a deceleration from the prior quarter in April, which was 105% and 39%. So it fell on EPS a little bit, but I mean, it's still a 76% change year over year. Sales went up from 39% to 50%. So NVIDIA is a strong stock. And I actually like NVIDIA better than AMD for a number of reasons. But nevertheless, the chart is, it's being recognized as being another leader also. And I think that's a pretty big deal. So.
And then there was one more chart, but I don't have the chat. We had to reload since I exited. So Dad, would you mind telling me what that last chart was?
Yeah, it's plug, Plug.
One more time. Sorry, you broke up.
Plug, Plug.
Okay. Yep. Got it.
Plug power.
Yep. It's loading up now. I guess my connection is just horrible, but yeah. So this again is a strong stock, obviously, as it's trending both above its 10-day and its 21-day. This is one that when the leaders were correcting back in July, it was also correcting, but found its way quickly back above this 21. So again, a super strong stock. I don't know the earnings, but I'm gonna imagine they were good considering the price action afterwards. It's below the $15 area in terms of William O'Neill's criteria, but at the same time, this stock is trading. It's very liquid. It's got a lot of volume behind it. So you could interpret that as some institutions are definitely holding this thing up. But yeah, maybe a little bit more sideways action here, and then a breakout would be an interesting short little entry. I would prefer to see. For me, I would have liked to have entered down here on this break above the 21 right before the earnings run. But again, you got to know that it's earnings soon. So yeah, this is the best area, risk to reward, in terms of where you're going to place your stop loss. But again, a super strong stock and maybe some more basing to let the 21 catch up, and then another good risk reward entry could be had.
Yeah, I'm going to take back control here. I want to show something here. So this is Plug Power, and I've got it set to the weekly here, and you can see that it still is running a negative earnings. This is actually in my industry that I work in professionally. They make fuel cell systems, and a fuel cell runs on hydrogen. So it's a clean energy source. Its byproduct is water. So that's always a good thing. The fact that it doesn't have positive earnings means it's very early. So this is a new technology, but you can see over here how it's coming out of having negative earnings, and you can see that the sales are actually, doing pretty well. Although this last sales number of 18% change year over year is down significantly from the prior quarter. There could be a lot of reasons for that, and I'm not sure what they are without digging into the industry. I will say fuel cells are promising, but they're not in widespread deployment. We're not going to see them until more money goes into the industry. So it's definitely something to watch as an overall shift in the energy mixture in the world, but it's not something that is as reliable as traditional generation that we've seen, or emergency generation that we've seen, or now even energy storage using various chemical energy storage technologies. So that's something to look at. Let's see, are there any other questions or comments? While we're waiting here, I just called up NVIDIA just so you could see the numbers there down here. Again, this is the weekly chart for NVIDIA. You can see where those numbers are here. Any other screens? If not, we'll go ahead and call it a day. And I want to thank everybody for making the time. Share a link to my TradingView chart setup. Yeah, I will. I'll actually put it in the groups.io stuff. XPO? Yeah, we can do XPO. So let's look at XPO. Oh, that's interesting. So you can see, you're at an all-time high up here in these levels here this is the weekly that we're looking at here. We've pulled back. We've had a couple different buy points that are being identified within the Marketsmith environment. Again, we've had some more pullback here. We've had a nice basing period, and it looks like we're in the potential of breaking out on XPO. So this actually could be something worth looking at. So let's take a look at the daily and just see where we're at here. A couple things are a little bit of a red flag, and I'm just going to draw your eye to the bottom here in Marketsmith, where I don't know if you can see the numbers, but the earnings and the sales or the after-tax margin here are not where we want them to be. We want to see bigger numbers. So while the stock price is breaking out, it's not necessarily been on necessarily what I would call the greatest of price action overall relative to the S&P. You can see that the relative strength rating on a scale of 0 to 100 is only a 77. 78 is about the absolute minimum we would want to be at. And I know it's just 1 point above this. It doesn't necessarily preclude this, but it's certainly not an ideal rating with overall relative strength. You can see that we haven't even taken the high in February that we achieved here, whereas the S&P has already recovered its high, and as you saw, the NASDAQ is on track now to actually be even above that. So I think that's that's a pretty. There's nothing wrong with this, but it's just not. There's probably better places, at least from my perspective, for my money. I wouldn't necessarily be looking at this stock. Just looking over here at the chat window. All right, I think we're there. No other inputs here. We're at a little over 2 hours, so I want to thank everyone for for taking the time out of your day. Greg, any last words?
Yeah, I would just say thanks for everyone's time. Really appreciate it. I think going through charts and studying the market's super fun, so I hope everyone could find some value out of what we talked about today, and hopefully you guys would return for another one of these seminars next month.
Great. All right, everyone. Thanks a lot.